I know, just waiting.
Phone's off. Phone's off.
You're running wild one, right, man?
Oh, no, I don't mind.
Oh, I got a nice thing.
It's a plain and no. Good afternoon, everyone, and I think I'm about 15 seconds early, and I'll just say welcome to everybody.
It'll take 15 seconds.
Thanks for coming today, and so firstly, just a few health and safety just notes. So in the event of an emergency or earthquake, there's exits here and through that way. And if you're seated in the car park next door or over the road, I think everybody's got their phones off, and I think it's maybe further health and safety things. So just on to apologies, I have apologies from Councillor Ross Vickery, and Councillor Calenza will be joining us via Zoom today. So in favour? Councillor West, thank you. Resolution, all in favour? Motion carried. So does anybody have any conflicts of interest today? No? So no conflicts of interest? So there's A3, there's no public participation today. And therefore A4, there's no actions from the public participation today. Just before I move on to extraordinary business, currently we have under B1, we have financial reports first, and under B2 we have Darren Williamson from Marsh Insurance Company. Darren's coming all the way up from Wellington, and so we're going to move him into B1 first so that we can get away afterwards. So is there any extraordinary business for today? No. And so I'd just like to move on to the minutes for confirmation from the Finance Audit and Risk Committee for the 20th of August. Now, I wasn't present for that, so I believe that we nominated. Thank you, Councillor West. So, and can I have a seconder for the minutes from the Councillor Eames? Did anybody have any comments about the minutes from the 20th of August? Very short, very sharp.
This is a new standard.
And did you have any comments about the minutes from the 20th of August?
No, nothing from me, thank you, Lee.
And you need to unmute yourself.
I thought she did.
She can't talk anyway.
She has got laryngitis.
Okay, so Councillor West nominated. Minutes.
Bottom right.
Up top. She's unmuted. No, she's not.
It's sorted.
Oh, our sounds. Yeah.
Can you hear me now?
Try that, Pam.
Can you hear me now? I haven't got much voice, so.
You go to the left and click on where the hat is and unmute it. That's it.
Can you talk, say hello now, Pam?
Hi, everyone.
All in favour of the minutes, 20th of August being approved?
Yeah.
Okay, page 7, we have the notices of motion. Right, so I'd like to move on to B1, which was previously B2. And for those of you who haven't met Darren Williamson, and he's from Marsh Insurance, and so he's going to talk to us today about our current, the current aspects of our insurance and maybe some opportunities. He's going to speak for half an hour, and we are going to allow 10 minutes for question time. So if there's any particular issues, so this is really a briefing, but also an opportunity to ask questions.
Thanks, Madam Chair, and special thanks to Charlie and Katrina for the invite to come, and for me in the Hutt Valley. What a wonderful day. So thanks, folks, for putting on such a nice day. I'll just see if I can work this. Some of you might remember I came and had a chat to you back on the 5th of February, and my intention is to largely leverage a little bit off that, but also talk about the future a little bit more. Things have changed obviously since we all, many of us came together in February. So I think it's fair to say we should leverage off that as much as possible. I always find I talk a lot, so any interruptions to ask questions are always welcome. So please don't hesitate to do that. So I think just a couple of quick comments, and because we are limited to half an hour with questions, what I'm going to do is just remind you that from the majority of your covers, you are with your friends in Carterton and Masterton. I like to think we're all friends, so hopefully that is your mindset as well. Ultimately, in terms of the couple of slides that start my comments off today, it's really just about demonstrating several aspects which focus largely on the considerations which remind you what you'll spend in terms of your insurance covers are. So I just want to quickly comment on that. Without considering GST, the program that South Borough Rapid DC contributes is approximately 255k, of which about 177k is for property insurance. So it's quite a lot of money. It's by far and away your biggest spend. What I'm going to ask you to do in terms of your thought process as I work my way through this discussion this afternoon is thinking about how and why the council looks to insure. Might seem a strange question or a strange rhetorical question for now, but there's a big focus that I think is going to become increasingly important for multiple reasons. So just food for thought. A little bit of demo. Again, I focused a lot on this several months ago and or back in February. So ultimately it's more a case of just a quick demonstration of where your cover was back in 2019, 2020, 1 July being a key date, and where it is now. Acknowledging that it was somewhat obscured with the camera, but I think you get a bit of a gist, particularly if I remind you that comment I made a few moments ago, 177k on property insurance. Previous year, about 167. And year prior to that, approximately 147. So there's a trend and it's going this way. Okay? Food for thought. Let's see if I can work this.
So can you add?
Arrows? I see. Sorry. So you'll notice a couple of trends in this. There are references to joint policies and shared policies. Again, very, very normal, very specific, very standard for local authorities. I work in a sector at Marsh in Wellington, which is focused around public authorities. So the main people I talk to is councils with some ministries and central government related entities alongside. These covers are very normal, as I say. Just pausing for a moment. This sector of the council program is an individual policy, as it refers to, another area of problem in terms of cost. So again, property, public liability, but more so your professional indemnity. So I just pause on that because basically since 2018, the cost of your insurance for public liability and professional indemnity has largely doubled and then some. So roughly 20,000 in 2018, in comparison, about 46. So when I use that reference to doubling, it certainly has more than doubled since that time. So a real problem child. It's the area where we see a lot of claim activity from third parties facing the council, wanting some money. You'll know. Now, the main dynamic of my discussion in this half-hour period is really about this topic: risk and insurance and risk management. So New Zealand has had, in my experience, which is 20 plus years around the insurance industry, a huge focus that as soon as you own an asset, you insure it. And you insure it for the worst possible scenario, which for most of us is fire, storm, flood. But I think considering we are in this part of the country, we think of earthquake. No unreasonable scenarios there. What we don't give a lot of thought to is why we actually insure it. We just insure it, we pay a premium, we expect. But if something has become quite clear since the Christchurch sequence back in 2010, people don't often get what they expect. Be it from EQC, I did spend 12 months working for them, be it their insurance company, and there's arguments. No one wants those things. So when you come to look at your insurance program and what you insure, you need to think, what do I want from my insurers and EQC if it comes to a domestic property? Do we want to replace this asset? Do we want insurance to contribute the whole sum? How much are we prepared to take on ourselves in terms of our uninsured amounts, our excess, our deductibles? And then how long is it likely to take from the day of the quake to actually resolution? And then what is resolution? Is it when we have a fully functioning asset which brings money into our environment? Is it to actually to be able to inhabit the space? One thing is clear in all those circumstances, it's not a 5-minute exercise. So if there's one thing that I think this year, the most unique year that I think any of us will hopefully ever experience, and certainly I think most of us have to this point in our varying levels of maturity in terms of years, we have to be flexible. And COVID-19 has at least taught us that the ability to work remotely is to the fore. So the things that I suggest council and the audit and risk team should think about is why an asset is important. Well, we put people in it, but did you during COVID-19? Rhetorical question for the purposes of pace. So when it comes to looking at assets, and I'm being very general in my commentary, sort of questions that I think you need to ask yourselves when you look at your cost of insurance. Why do we insure toilet blocks? When we look at our claim record, and I could flash back to that, I did quickly skip over it. We don't have a lot of claims. If I look at 2018, there's been, I think, several that were introduced and not necessarily around property, motor, not focusing on motor with a lot of these comments, but you spend in terms of your return, if I can call it an insurance claim a return, there's nothing. So you're outweighing a lot of money to an insurer or series of insurers, because there are a number that make it up. You're not actually getting any comeback on it. Thankfully, there haven't been a great deal of losses to actually warrant it. But that traditional model that so many of us Kiwis and people that have moved to New Zealand are continuing to do is we own an asset, we insure it. We don't give the thought process to why. And we don't give further thought to in terms of what we would want to do if that asset was lost to our council and to our community. It's something that does need to, I feel, have a greater focus. I gave you a very brief example again on how the costs are going, roughly 15% increase 2018 to 19 in terms of the cost of your program, property, 6%, which is very amazing in terms of the industry I work in, what we've seen between 2019 and 2020. It doesn't really recognise the key words before COVID, which are also a C word, climate change. Climate change will start to have a massive impact on the cost of insurance, whether you be in Martinborough, New York, the Bahamas, any part of the world. Just going to be the way it is. So to start having these discussions and start having the thought around why we insure an asset when the cost is going to be probably more like this, and then insurers will start to influence their premium around their COVID losses, not because in terms of property insurance there's been a huge amount of claims, but certainly there's been an implication that we can expect it to influence every sector of insurance, because they too are a business and they list on the stock market, and therefore their capital value has dropped. So they've got to work out how they can respond to their shareholders, and premiums is the obvious space. So having these discussions are really quite important. It just makes you think, why do we need to have that asset? What's our purpose? What would we want? Those same questions resonate. So in terms of what's on the list, point 2 and point 1, perhaps cap in what I'm talking about. Risk transfer solutions. Again, I've talked about insurance being the focus. Why isn't it time to consider insurance as a complementary, not the main? Self-insurance, pretty scary topic, but in terms of actually how you outlay your capital, maybe it's not the time to think of 75, 80%, 90% to your insurer. Maybe it's more to go, we are prepared to accept 40% contribution from our insurers, similar to what currently happens with LAP, 60-40, which will probably change before too long. Smiling, Katrina. It's been talked about for a long time. So the time is there to start having these discussions. Sadly, at the moment, to be an investor and to put capital into any area is not going to provide you a great return. But it's better than putting money in the insurance company's pocket, because that doesn't give you any return unless you have a problem. So again, it's just changing the thoughts is what I'm getting at. It really is quite significant to bring that into the mix. In terms of the fourth point that I make on the slide, uninsured and emerging insurable risk as part of the annual insurance review process. I've mentioned climate change. I spent a large amount of time since February talking about notifiable infectious diseases in reference to the Health Act. That's the normal exclusion that features in so many insurance policies around New Zealand. Largely became part of most insurance policy response in terms of property or material damage, if you will, when SARS became a part that thankfully didn't really affect New Zealand, but did affect a part of the world. So insurers started to constantly write that in. I think I have probably 2 or 3 clients who I deal with, interestingly enough, public sector, who have a wording that's written by a European group of insurers around fine arts of all things, that we are currently in the process of tackling these insurers on in terms of giving them a COVID payout. That's 2, just 2, very few. So again, when you start thinking about your insurance program and from an audit and risk capacity, these are important discussions. You know, have we learned a lot about how we operate because of COVID? There's always some lessons come out of the negative, just in case sometimes it takes a little bit of time to find them. The last thing I'll put on this page, and I'll reference to additional material that I did bring with me. Sometimes considering self-insurance versus the traditional insurance model is really quite concerning or scary. You know, how do we know we're making the right call? That's not fair, nobody does. You do something today and then suddenly a major event happens tomorrow and you feel terrible. I think that's probably the right choice of words. In your risk management forum, the sorghum events that many of you will know of, the RMS, another aspect, all quite useful tools to actually bring into the equation, give you a little bit of confidence. But a greater level of confidence, without making today seem like I'm pitching a sales thing to you, is I have a group of colleagues who are specialists in this. And my intention, as I was talking about with Charlie and Katrina this morning, is to introduce them to you guys and to your colleagues in Masterton and Carterton, so you can start to understand the additional resource that can be introduced to you. Determine if you want to follow the train of thought that a little bit of this talks about. But it is definitely the time for discussion and really is important, with premiums going to go more like this and that over the next few years. Certainly there's not going to be a slowdown. certainly it's going to be a case things are going to get tougher. And we talk about hard and soft markets. Hard markets are really where if you're a seller of insurance, you close the door and the person buying finds it difficult. Soft market, the buyer has the power. I haven't seen a soft market, I think, for 10 years. In patches, we've seen improvements, but that really was before the Kaikoura earthquake in 2016, if I can call it that. So we've been in a very difficult period for at least, as I say, 8 or 9 or even 10 years. So insurance, no one likes it, let's be fair. Some of it puts food on the table, me. But apart from that, we'd rather not buy it if we could predict. And, if you can save some money and spend it in other areas of your community will be happier for it. It's just a case of how you balance that expenditure without trying to compromise the assets like this one that are absolutely important and impressive at the same time. I digress a little bit, but hopefully that message is a resonating one. So the type of scenarios we see, and I'll diverse into a little area in a moment, but contract works. So that's again your building stage. And one of the key things that's going to become increasingly relative is, of course, how you invest in your communities by central government calling it shovel-ready projects, I think is the catchphrase. So in terms of why I brought this into the mix, if you have some new projects in the wings, some greenfield projects, how you manage those, what's the process? And I have spoken a lot to different parties around councils. There's quite often a desire to have the contractor insure the greenfield project. What I've recently seen for a council not too far away from here, without trying to be completely open in who that is that can provide problems, particularly in the COVID area where what if these contractors go out of business? How do you know what they've arranged? Who's going to pay for the end of the project in terms of insurance if then something happens? So if you are looking at a greenfield project and you are going, that sounds great in terms of costs, that sounds great in terms of cover, and save a job off our plate, maybe think about the other side. What if we don't know what we're covered for? What about in terms of control? It's gone. And then what happens if that particular contractor goes out of business? So I'm just digressing somewhat, but in terms of risk, it's about thinking about losing control. And in terms of sometimes it's about what you pay for in terms of the project. Brownfield contracts here, probably not needing to touch too much on that, but hey, we're here to help you for those existing structures, which are an absolute must anyway, because you have to keep it with the same insurer without trying to overplay that. Elections insurance, event cancellation insurance, transit insurance, they're all on the list. Event cancellation insurance has been a massive scenario. I mean, a lot of people in my neck would start to get excited by the T-word at this time of the year. Post tickets. Yeah, so aspects like that are all relative. They all bring money into your community. How do you deal with that if that money is going to provide things to your community and then suddenly it's not there? That's something that's available. But most importantly, COVID-19 not available for that for reasons that it's known. Wimbledon is the only major event that I can think of. Notably, it was cancelled, and you might, if you follow tennis enough, you know that the other 3 Grand Slams went ahead. Why did they go ahead? They didn't have event cancellation insurance, at least to cover that pandemic. Wimbledon did, and may I say it was an excellent broking firm that actually placed that cover for them. You can work out who that was without me needing to tell you. They had bought that type of cover for years, but equally, we're talking different scale. And transit cover, probably not a great deal for me needing to touch on that in terms of today, but just a reminder, moving property one place to the other, land, sea, rail or air. A couple of things that we've started to talk about more and more, and the second one on the list in terms of bullet point got a huge focus this morning.
We've just got a few minutes, so we do allow time for questions.
Yep, sure. So we've got about 5?
Yeah.
Okay, 5 and then questions.
Cyber risk is a good one to come with.
Yep. So in terms of how I would rank things for you, in terms of your overall program, cyber risk probably needs to be close to the top. Take us out of the COVID era. We are seeing an increase and a steady one around loss around that. That can be unsophisticated, what I call social engineering fraud attacks. Here's an email with a phantom invoice. How do you react to that? Both Charlie and Katrina saw a significant presentation from two of my colleagues who are cyber specialists this morning, and we're going to explore those scenarios a little bit further in terms of what the real risk is to this council and ultimately how you might consider an insurance solution in complement to what you currently do. So it's more about giving you the tools to understand your risk and respond. Employee benefits, that's another one as well that has become increasingly common and important in terms of the people side, particularly for those that lose their jobs. Now, the claims side, this paints the key picture for me. I talked about it a few moments ago. That top one, none, not a bean. And I will add, South Fire at the DC has a very low excess or deductible, 5K, for the majority of claims other than natural disaster. This is your property, so if you have a fire, nothing, a storm, nothing. Pretty significant. There's been nothing. Particularly when you think of that expenditure that I reeled off before. Motor claims, again, pretty good. Because the costing and premium that the council actually outlays to insure the motor side is quite low in terms of other councils, the fleet is also quite small. I wouldn't worry too much about where I talked about loss ratios exceeding 75%, which an insurer would regard as a deteriorating or negative loss ratio. That basically means for every dollar paid in premium, you guys have claimed back 75 cents, if that helps. And the other aspect, even though I'm talking about the rising costs a little bit earlier, no significant claim activity other than you've let us know something could be coming. Again, you're an insurer's ideal customer, other than for motor.
So this is fantastic, all of this. One of the things I remember you talking about last time in terms of vehicles, for example, it's cheaper for us to actually not insure vehicles more or less because we have such low claims. The other thing, just when you're thinking about questions, if you look at, let's take Greytown Town Hall, let's take Anzac Hall, should we be insuring it to the full amount? Because actually we couldn't replace those buildings because they're just to replace them. So would we then rather build a bespoke building that is quite different and very possibly cheaper? So those are some things to think about when you think about replacement.
Very much so.
But look, I'm going to hand it over to questions because, Brenda.
Okay. When you review the council and the assets that they have, are you reviewing it on what they previously had, or are you having a fresh look? Because we sell our assets from time to time, is that reflected in the insurance?
Yep. So in terms of values, the sales side, we don't pay any attention to that because it's the rebuild cost, it's the demo cost.
But if we don't have that land anymore,
Yeah.
there is no commitment.
No,
Every year we review the list, yeah,
Every
yeah.
year, they get a review list of any new assets, any sold assets.
Yeah. So in terms of what Madam Chair raised, I think that the key scenario is in that type of dynamic. So you ask yourselves as a group, why we insure it? You ask yourselves, we insure it because we want to replace it, or reality, a cash settlement from an insurer, including a demolition estimate payout. That's what we see. The money's paid, any debt, if necessary, is considered, and ultimately council can use that money in a way that it so chooses. So we're talking worst loss scenarios, major total loss, if you like. In terms of partial losses, it becomes a bit more challenging. But there are other options that you can discuss with your valuers during that valuation cycle, and it's called functional reinstatement. So you might look at an asset and go, yeah, that's worked very well for us, but if COVID taught us anything, we could probably deal with a structure that's 3/4 of the size or offers only 3 out of 4 rooms, because we don't need that anymore. There's no reason. So of course, 3/4 of the size, 3/4 of the value, maybe. So 3/4 of the insurance costs. There's the flow. And it gives you still the benefit of having a sophisticated insurance solution, but more so it allows your expenditure to be tailored for what you want. So it's that question again. You're answering the question of This is why we insure the asset. This is what we'd want from our insurers should a scenario occur. And properties your really area where you can start to explore it, because you're going to have, in theory, the biggest saving. Leading up to 1 July, when we renewed the cover for the 12 months through to 1 July next year, I offered something which was not really seen as anything other than some food for thought. I use that term a lot today. And that is councils within the Wairarapa, all three, we don't include the regional council in this. Why don't you look at what we call a natural disaster capacity limit, which rather than every council insuring to the fullest value of its total sum insured for assets or property, you actually look to insure on the worst case scenario based on the modelling, the science, so that if you had another major earthquake, you would have at least enough funding to rebuild those key assets. This is mainly above ground assets I'm talking about rather than your underground, by the way. But it's still a key thing, like if you absolutely had to only rebuild the structures because of capital, what would those be? And you almost have to have that type of discussion. If there's overflow, is it nice to have? Is it worthy based on the top schedule alone? No lost damage claims since 1 July 2018, actually outlaying all that expenditure when you could have it in investment, gold, or whatever seems to be the go-to, and have some positives for the community where you expend the money. The challenge is no one knows what the future holds. Who would have thought 12 months ago, even in February when I stood here, that COVID would have done what it does to us? So there is that challenge, but history gives us the best indication, and that's where the modelling advice that I can introduce the council to may be helpful.
Just I quickly want to go around the table if anybody else just had the opportunity to give a Alex, you've got some questions?
Given that we haven't had any claims for 2 years on material damage or 3 years on public liability, but our premiums have increased 15% and 6%, are we being charged for our premiums based on our risk profile?
That's a fair question, and you would think so, looking at that. So when Marsh go through the process of negotiating renewal, we do it almost as a program that you come together first with the other councils, and if you like, they influence you, you influence they. So if the councils in the Wairarapa as a group have a bad year, but South Wairarapa has none, you will find that your rates will adjust. But on a bigger scale, what the insurers, which is QBE Insurance led, they are the principal or main insurer, they look at the performance of all Marsh councils throughout New Zealand in terms of how what we call the book has gone. So in that, there's a large number of councils from Wairarapa to Southland to the top of the north. And within that, they go, how did that book perform overall? And if it performed well, the rate increases are kept to minimum levels. So if South Wairarapa DC wanted to go out on its own and have a look at a program to compare, you'd probably find that the rates would be heading up more significantly. And this comes back to the comment I made earlier. So 2018, 2019, we got a 15% increase. 2019 to 2020, we got a 6%. Now, anything lower than 10% is pretty amazing in terms of how insurers look at the public sector business. They look at several things. They look at, on average, how many buildings are built like the one we're in. 100% code in terms of MBS. How many buildings are under 33% of code in terms of earthquake prone. And ultimately, they don't underwrite specifically per assets or necessarily underwrite specific per council. At the end of the day, it's generally done as a portfolio, and ultimately you won't be penalised if you suddenly had $1 million claim.
So we subsidise other councils that may be poorly performing.
Well, that's what it looks like.
Yeah,
That's
well,
what they're telling me.
yeah, no, I think what you could say is you are all in it together. The traditional format of any insurance is you'll pay a premium into a pool, and out of that pool comes a cost. So if you suddenly, and I take your point, if you suddenly had a major loss, and let's say it was this structure and the loss was $1 million, would you want to become uninsurable? No, I don't think you would. You want to have the choice to insure. So if I take one council that is not in this part of the world, but is in the North Island, that has had since 2018 one claim which has cost about $1 million. They are still insurable because the basic concept of insurance still allows a pool of premium to be put together, and ultimately the claims paid out of it.
So I don't see anybody got any other final questions.
No, I think it's like the discussion.
Yeah, I think definitely it's food for thought. There's a lot of interesting ideas and options there. Thank you so
That's right.
much for very long. I really appreciate it.
I just want to make one final comment that perhaps gives a concept and understanding around, that I knit together and perhaps you're subsidising others. Most of us have seen the headline in terms of the Wellington region, where a major insurer, IAG, which encompasses the NZI, the Lumleys, the AMI grants, to name three, they don't want any more domestic risk. They don't want any more domestic risk because they've got the majority. So suddenly if we had a major earthquake, they could go out of business. That's an extreme scenario. So in terms of pooling resources, we wouldn't want Martin Borough, South Borough, the DC to be left in the loop. So it has to be the dynamic where you are in it together. And it does work, particularly if you have a claim better. But now is the time to have the discussion around why you insure. That's probably me done. So, yeah.
Thanks.
Thanks so much. Thank you very much for coming. Thanks for coming. Just before we move on, I want to just formally receive the risk and insurance presentation. Can I have a
Lee, can I ask a question?
Yeah.
Sorry, just from there, in your slide, one of the slide, there's a couple of questions actually. In your slide further on, you had one quote in Australian dollars and one quote on the next line down in New Zealand dollars. Is that an Australian company that's going to underwrite that section? Sorry, I haven't got this in front of me, so I can't, I recall seeing that in your slide.
Yep. So, thank you, Pam. Firstly, in terms of insurers available to councils, full stop, if I was to give you all the insurers that are named within your program, none of them are New Zealand. Okay. So I've said QBE Insurance Australia Limited, but in terms of your public liability program, QBE UK or Europe. So it's a major multinational in terms of insurers. Ultimately, they are the lead insurer, QBE on material damage, business interruption, and public liability and professional indemnity, but they're one of many.
Okay.
Otherwise, the one insurer on its own couldn't write the program. It's just too large.
Okay. All right. The second question is that you're talking about us risking as the council, taking on some of the insurance risk ourselves, but I don't see anything in your presentation that tells us what difference that will make in our overall premiums if we take your advice.
Yep. So that is a process where we would work with Charlie and Katrina to explore that. It is a case that we'd give you greater tools than me standing in this particular format to actually discuss how it's an important thought. It's more about having some tools available, some science, some math, to actually understand the positives and the negatives of taking one step or the other. Obviously, I'm driving things more out about how you might make some premium saving. If I stood in front of you and your claim record indicated something different, obviously the thought process might still see modelling to your advantage and how to maybe look at supporting insurance with another means of risk mitigation. But it does require quite involved discussion rather than me being able to give you a concept. I can always give an idea, but that doesn't always achieve the aim.
Yeah, because I think we as a council have to weigh up the potential for paying a premium that covers those things and building up a reserve that the opposite is then we have to build up a reserve to cover those things that we don't have insured. So we need to sort of have an idea of what that saving is going to be as opposed to what we need to allocate out of the rates to cover those if we have a loss.
Yeah, Pam, I think that's something that we would have to explore in more detail. We would have to look at some scenarios of what we would choose to not insure.
Mm-hmm.
And then we would be able to ask Marsh to look at what the premium potential savings would be on that. So it's discussions first, and then we could come up with some dollar figures.
Okay, can I then ask one more question, Charlie? Under the things that we have got covered, like in June when we went through the list, I didn't see the Payne Farm or the Payne Farm house and homes, the homestead and the cottage on there. And so in the insurance cover we've got, do we actually cover those things for the loss of rental, the loss of income as to?
No, it's purely material damage type cover, Pam. We don't have the income loss covered.
Okay, thank you.
Thanks, Pam. Thanks so much.
That's right.
Thanks for coming.
Again, thanks for everyone to be here. And if there are questions, including your own, that you want to address offline, Katrina or Charlie can filter them.
Thank you.
Thanks,
Thank
Darren.
you very much. So just going back, I need to receive the risk and insurance presentation. So Councillor Duke sending that. Can I receive that, please? And all of those in favour? Aye. So we're now going on to what was previously B1, but is now B2, financial reports. So, can I ready to receive the corporate services report? Councillor West, and a seconder. Councillor Evans. Favour? Right, perhaps what I might do is get Katrina to talk to this, and then if anybody's got any specific questions on what was B1 in your reports.
That's fine, thank you, Lee. Okay, so I've got a little bit to cover off here. So what we've attached is the financial statements up to the 31st of August, so the first 2 months of the financial year. So also the investment policy, the rates of arrears, commentary, update on NZTA, Wellington, budget costs. So I'll just go through the report and just sort of stop at some, I guess, points that I think we might want to discuss further, and then I'll open it up for discussion. So the investment policy, that's all around the spread of our term deposits and where we invest them. So the policy says we shouldn't invest more than 30% in any one bank. This policy is up for review for the long-term plan, but as it stands at the moment, this is what it is. So there were a couple of exceedances in June and July, but we've got those back under the 30% for August, and we're not anticipating that that's going to be breached in any time in the near future. One thing to note, term deposits are the only investment structure that we have, and we're currently getting 0.97% for 1 year investment.
Huge, isn't it?
0.97 is the latest I've got. So
That's actually bad. Yes. But it could be nice. I see the last time.
yeah, no, you're right. It certainly could be worse, but there is, yeah, I just wanted to point that out. I'm not sure that we thought it was going to drop quite that low.
What are your expectations with regards to future jobs?
I can't see it going much lower than that, to be honest. But if you look at the long-term interest rates, I think it was something like if you invested for 27 years, you got 1.22%.
Okay.
So I think from that you can gather that they are expecting interest rates to stay quite low for some years, probably at least the next 3 years. Yeah.
I mean, one of the good things is you do have a few, not that many, but going out a bit longer term, that you've got last year for 2.6.
That's right, and some of those haven't matured yet. So the average interest rate is still kind of, being buffered a little bit. And loans, of course, also mature at different times, so they don't sort of line up. So we might only be 0.97% here, but our average borrowing rate might actually be 2%, where previously it was actually around the other one. Anyway, just something to note at this stage that we're working sort of through. But as we roll over loans, of course, the new interest rate will be significantly lower than the ones that we've got. I'll just quickly go over the rates of arrears, because I don't think, unless there's anything that anyone wants to specifically ask about, we are monitoring it. We feel in a really quite a good space at the moment with where our rates of arrears are sitting. We are closely monitoring it, but we're not expecting to see these effects of COVID for some time yet. I think the next couple of quarters will start to give us a better indication of what sort of is happening out there when the government subsidies perhaps come off and the recession starts to bite, I guess. Yeah, but we are seeing an increase in the number of commercial properties that have rates of arrears, which is a little concerning, because there's two scenarios there. Not necessarily the business that is not paying the rates, because it could be owned by, the building itself could be owned by someone else. So we're just monitoring that at the moment, because there's not a lot of properties, it's just that there's a little bit of a spike there. So yeah, so we are monitoring it and reviewing it, and if necessary, we will undertake a campaign of calling people and having a chat to them proactively. But most of our ratepayers are getting into the pattern of ringing us and being proactive about calling us and letting us know that they've got issues.
So the spikes, Katrina, was that just an annual spike?
Yes, so what I've put on the graphs is more than 1 year, so you can see what those spikes are. Otherwise, it looks pretty horrendous, because that's when you do your first lot of invoice. Yeah.
You've actually done very well, because mostly it's less than previous years.
Yeah. In terms of number of properties it's happening. Okay, so we'll move on to book 4, which is NZTA funding assistance rates. So that's the FAR rate. So NZTA have notified us that they have reviewed the rates, and now from the 2022 year, our FAR rate will drop from 52% to 51%, which means the ratepayer needs to fund another 1% of our roading network. The special roading rate, SBR rate, is currently at 100%, and that is for a special purpose road, which is Cape Palliser. So NZTA at the moment is currently paying the full cost of maintaining Cape Palliser Road. They have for some years indicated that they actually want to bring this back in line with the FAR rate, so in line with the 51%, but we are pushing back on that, and it hasn't happened yet, so that's still there as a risk, but at the moment they haven't indicated that they're going to go ahead with that.
When they likely to make this decision? Because that's a very...
Last long-term plan, we actually built in the expectation that they were going to drop it. So we will probably do that again for this long-term plan, because they won't drop it from 100 to 52, they will do a gradual.
Do they have to give us notice of that?
Yes.
How much notice do we?
I'm not sure. I'm in contact with the roading manager quite regularly about this, and they, I believe, have written a report, because there's other councils involved that have SBR roads as well, special purpose roads, and they're sort of taking them all to NZTA as one sort of report, and they're waiting to hear back from that. But I'm definitely still actively monitoring it and asking that question. We will definitely need an answer before we go ahead with the long-term plan.
I've been talking about it for 5 years. Like,
They have, yeah. And they're still talking about it, so we still do have to be recognising it as a risk.
Do you know how much they've spent on the road plan?
A bloody lot.
We would know, just for a correction, I think it's only 7 kilometres of risk.
Yes.
So it's not the whole road.
It's just down.
It's a 7, so that's the
Sorry.
compromise we made.
Did you say 7?
7
Kilometres.
Is it
7 kilometres. Yeah,
So
so
the problem areas.
Yeah.
And that's what we're,
so Johnson's Hill, those type of
we're
things, just to be
going
clear, I mean, it's-
around what the they say.
so we don't claim 100% for the bits that are fine, it's just that we have the greatest risk, which I think has been a good advantage for us in terms of.
Absolutely.
So we're trying to be fair, and they're trying to be fair.
Well, they showed it, how they appreciated what 20 years ago. They rang up Tim and said, if you could seal between now and Mangacote and have a double there, the Jim will pay for it. Of course, we took it, didn't we? Yeah. So, they appreciate it.
I mean, well, it certainly exposes us to risk of the people. Now we open, if we have even if we have a 48% liability on that. Yeah, because that is a very expensive piece of work.
And I mean, one of the key here is that there are a number of councils in New Zealand that have special purpose roads. The special purpose roads were originally put in place predominantly for areas like access to regional parks, to national parks, or so like Waikiri, Moana, or those types of things. So they were a conscious decision at the time, because they were beyond the affordability of a number of councils that you afford to own and maintain. So I would keep an eye on this space. I don't think that's a done deal yet by any stretch of the imagination, because it's a policy. It was actually framed up at the time. So what NZTA did is they used to have a number of far rates for all sorts of different activities, so 10% above improvement. So essentially what it is, they wrapped everything into, intention was to have one far rate that covered a number of activities, and special purpose rate was one of those. And so there was a policy decision, and it's a policy decision by the board. So it's not a minister's decision. So I've watched the space. I suspect that they're going to find it hard. The reason they supported in the first place was because of the council's ability to afford and maintain. And there are many places in New Zealand which are essentially tourist destinations, and that's one of the rationales for 7 kilometres, because of the tourists that we have to go out to balance it. And so they're putting at risk a number of tourist destinations where a local authority can't afford to do it. So I think, long story short, I watch the space. We have to plan that may.
I guess on the plus side of that, we have rural roading fund that we've built up over the years that we've never had before. So I guess, we have been paying for a while, but it may change.
They could get wiped out in a bowl in a cycling bowl.
And so can every other road.
Yeah, and talking to Tim, he said if that did occur, so it would be emergency works and NZTA will cover it anyway.
Yeah, so NZTA has a separate fund for emergency works. So the sad thing was, it is literally if there's been an emergency and it's occurred. So it's not you're doing something to prevent something in case an emergency occurs. So that's just too big to already won't drive a truck through.
Yeah.
So there is contingency funding, if you like, in the National Land Transport Fund. If there's disruption to road or it slips, that's how Kaikoura got funded, how Christchurch and so on.
On the far rate, 1% loss, I think we did better than a lot of councils. I think Papawa got 3%, you can imagine their rating cost.
Yeah, they were higher than that. Their percentage was higher.
Yeah, but they took a 3% hit.
So coming out to us.
So it's a balancing exercise across the country. So there's so much money that goes into the local road maintenance and activity funds. And the far rate is calculated essentially on council's ability to pay. Right, so councils that are wealthy, of course, viewed as with fair due to their rating base, 51 is the lowest. Right, so this is the lowest. So we're in the category that actually says we're from the metrics that NZTA has, that we're one of the councils that has a a high ability to pay, apart from the special purpose road. By contrast, something like the Chatham Islands gets 100% back because they have no ability to pay. So it's a scale based on, so even if you try to argue to increase your bar rate, other council will go down to compensate the water.
Excellent.
Okay. All right, so next item on the list is Wellington Water and the capital expenditure budgets. So I wanted to just flag to this committee what Ewan had already presented in the Assets and Services Committee about two projects that are looking as though they are going to go over budget. One being the Papawa capacity upgrade. We had put $1.8 million in the budget and that had been carried over from a previous year, and that's now been recently revised to 2.8 million. There is some contingency in there, so that may not be the cost that it settles on, but this is what Wellington Water are flagging to us. Pinot Grove capacity upgrade, once again, the budget was 300,000 and they're looking at revising that to around the 860,000 mark.
So I think all of us have got a few questions around this. We couldn't find, and happy to be pointed to it, where it was flagged in Assets and Services Committee, that extra 1 million.
So I'm not sure whether the actual cost was flagged, but the project was.
No, it wasn't.
No, none of us have any recall of it.
I'll check on that. I'm sure I thought it was in Ewan's.
I can't recall it.
And the other question was around Pinot Grove.
Yeah.
So, this is Pinot Grove, Martin Grove.
Yeah.
So that is a private development?
No, this is, so I don't know intimately all the projects, unfortunately, what they're about. It's called Pinot Grove, but it's a capacity upgrade for the wastewater, but that feeds through Pinot Grove.
It's not just for Pinot.
No,
it's
it's not just.
It's the same with the Papawa and Pinot Grove. So if you connect developments, you would have to look at what, it's not just what the development cost is into the main, it's what the main capacity is to the wastewater. So the capacity upgrade relates not just to the, so the developer pays the cost proportionally for their own connection of the system, but it also triggers if there's a cost to upgrade the main, we calculate that all onto the developer because the town itself may grow for a number of different reasons, subdivision and so forth. So, for instance, the Papawa has as much to do with the orchards as it is to do with our Papawa. It happens to be the main pipe that comes through to our Greytown wastewater plant.
Can we not use some of the development funding for the,
Yeah, we very well can. Yes, this could very well be funded from that. But this is just highlighting that these are going to go over budget. How they are funded, they're not going to be necessarily funded directly from the ratepayer. They are more likely to be funded from the infrastructure reserve because they are upgrades.
I think the concern here is probably more fundamental. Is it how Wellington Water was up 55% on a capacity on spend, and and also Pinot Grove capacity upgrade, and also the Bethesda Mighty pump, which was omitted from the project scope. What's going on?
I mean, it's not at all good
No,
to suddenly be landed this, and we're not talking just 100,000 here, it's a significant amount. And it's in fact not just the councillors around fire who've expressed a lot of concern about this, but other councillors don't sit on fire.
I suggest that we request Wellington Water to come and talk about how they do their cost estimation and their reconciliation to the next access to services so you can understand what the issue is.
I think that we say fire needs to be aware of very much where this is.
But I'm just saying it starts with the access to services.
yes.
And then because you're concerned with the risk, the this is assets and services considered with the operating costs. So the first group must be for assets and services.
I'm concerned with the process that this has landed on our papers, that none of us had any idea, and also that the percentage increase, not just percentage increase, and why, and the other concern I have is that there's no timing detail around this, that this we can afford in 2025.
So if I can just fill you in on that, because this was raised with, we have a monthly financial meeting with Wellington Water, and this was raised at the last meeting. Sorry, we've just had one last week, so the meeting before that. And so it was just as much of a shock to us, and we certainly expressed our very strong concerns about how we've gone from setting the annual plan only in April, May to now having such a large increase. So one of the things that they have said, they did say that the project was scoped incorrectly, but they are going to work within our budgets for the year, but they're going to rephase the budgets. So for example, Papawa, they won't be starting until later in the year, and they'll only be spending the 1.8 million in this financial year.
Yeah, what I'm concerned with the details, they obviously had details to work on which we've never seen. Can we have access to those?
What details are those?
Well, it says capacity, and it seemed to me that if Pinot Grove concern or Papawa concern is because of developments that have happened in the last year we didn't know about, then that's, part of the rest of our organisation. But did they not know, and did we not know that it was going to be a capacity problem for Papawa this year, and it's gone from 1.8 million in August to 3 million in October, and I'm really nervous. I just want reassurance it's not going to go to 5 million by Christmas.
So one thing to note is that these projects were in the annual plan. Papawa was actually in the 1920 plan, and wasn't done, so was carried over. So they have been highlighted for some time that they're not new capacity issues.
It's not at 3 million.
I completely understand that, and that is something that we are still talking to Wellington Water about, and I believe that Harry's got a discussion with Colin coming up.
And can I say the same thing about I'm concerned about the electrics or the Featherston Wahine? I presume that you mean the pump at Wahine, or you mean the pump at Featherston?
That was at Wahine. So they had taken this on the chin and taken responsibility for this. They didn't quote for the upgrade of the electricity supply to power the new bore and pump. That's what that extra cost is.
Yeah, right.
We still pay that.
We still
Yeah, can I also ask, who actually scopes it? Do they scope it, or do
They do
use
scope
an outside consultant? It seems to me, if somebody dropped the ball for $650,000 worth of a power upgrade, it'd be quite nice to know who it was.
Okay.
Please find out.
I mean, it's there, that's.
It's
huge.
I've said there's a lot of information you need, and we can't answer them here, so we need to come to it. So quite appropriate, this really could go to assets and services.
Yes, that's right. Yes.
So I would check with you on why their comment was made, because I assume it had. And so you can get an understanding of what the works were, but more importantly, what their budgeting and procurement process is. Because you need to have confidence that between the budget estimation and the actual program procurement that they will include. They're not going to be a variation in scope of this order of magnitude. Next conversation we have.
I'm sorry, bring the first and then
I know this puts you in a real sticky situation. However, an overspend of $1 million, who's authorising that?
That's a very good point. So when it was raised with us at the meeting, it was one of the questions that I raised. This has not been necessarily approved yet. Because what I'm doing is highlighting to you that they're saying that this project in its current scoping is going to go this much over budget. What I said to them in the meeting I had with them was, well, we've got two issues here. First of all, we need to get approval to whether we want to accept that additional cost. And secondly, whether there is another option in terms of what they deliver, to deliver within the budget. And secondly, or thirdly, whether we roll that, we accept the cost and we roll it over a longer time frame. So
it hasn't been approved, that's why the budgets are being phased, so that would be telling you have to move within the budgets now and rephase the work. So we can actually do due diligence on what it is they're actually telling us these costs are.
So one of the other major concerns that was brought up is that Wellington Water have got, last time I knew, they've got 26 projects on the go, no timeline as to when they're going to be completed. What assurance are we going to be given that these are actually going to be fixed? I believe that the Papawa was 18-19, we're now into 2021. That's
18.
About 19.
So you need to ask those questions, yeah, also just bear in mind, Wellington Water only took over in 1 October last year. Yes, yeah. So they weren't the ones that did the estimation of the Papawa when it was originally put into the annual plan. Or for the, but we did ask them to do the estimation of the works for the second plan, right? So they weren't there when those decisions and those order of magnitude costs were in place.
the only reason I raise these concerns is that this is not the only, we're not going to be restricted with these 26 that come in online. There are going to be other things, but what I'm not saying is when they're going to be finished. When are we going to see an end to some of these projects? When are they going to drop off the list?
No, I think that's a really good question to ask Wellington Water.
Yeah.
Because we have time constraints on the $2.8 million PPP. That must be steered within that particular time.
That's exactly right.
You're right, Alison. I think Harry mentioned before, we've got an assets and services meeting in 2 weeks' time. And I think if we can get some answers then.
I've raised this with Ron and actually asked him to turn up.
I'll go.
And I guess the other thing is, and Abby, I can see your fingers, is this is obviously not the first time that we've had significant concerns over overspendings with Wellington Water. And I just hate to think this is a bit of a recurring theme that is going to pop up each meeting. So Brenda, just had Pam.
I see some issues in the in extending this out. They've given us costings now to do the work basically straight off. If we defer this for 12 or 24 months, then there's going to be an added cost onto this, and also probably some time lag in getting, whoops, gone.
Are you here?
I can't see you. It's some time lag in getting the actual parts and stuff like that. So I think we need to get some sort of advice as to the availability of the equipment, you know, the parts and things like that that they're going to use. And if there's a delay, what added cost that is going to be to getting that work done.
Good point, Pam.
Because that's what I'm saying, we need to bring this to assets and services. Yeah.
So if I can, sorry, just to refer to, I've just looked up the reports that were put to assets and services, and both the Papawa and Pinot Grove have been flagged as red on the dashboard. So they flagged as high risk, and they're going to be coming in as higher than budgeted. So Ewan has actually said that.
Yeah, I just couldn't remember any discussion around it.
Well, yeah,
But the risk is that the best outcome is to get Wellington Water coming to say to the assurance we as an organisation is that their budget and the procurement, that we have confidence that when they give us a budget figure, a cumulative budget figure that we're planning on, that we have confidence that the service is going to be within range of that. The scope increase is something we continue in your contingency. So it's very usual for a capital project to have about a 20% contingency.
Yes.
Push it happens.
And also emergency works happen as well. So we don't, Wellington Water don't necessarily budget for emergency works because it's very difficult to know what is going to happen in terms of disasters or things that have been undertaken, like the Lake Ferry drip lines is, I guess, one of the product examples here.
So, right, Alex.
Chief Terry, if you could pull out of this any concerns that may be of the governance nature, to send through to me, and I'll forward it to council that raised at the Wellington Water Committee meeting coming up. Because I just want to make sure that the questions are asked if they're of the governance nature. The second one is with regards to the Lake Ferry drip lines. Will we be paying for this, or will they be paying this under insurance given that it was operated clear up?
That is still under discussion. We have been pushing back to Wellington Water to say that the direction for where the contractors were to dig was given by Wellington Water, so potentially it should be claimed under their insurance. So Ewan's got that in hand at the moment.
Thank you.
Also, Alex, a report from the Lake Ferry Water on some services.
Yeah, that will be.
While we're asking questions of Wellington Water, could we also ask, we're doing the Papawa and the Pinot Grove as upgrades for capacity. Can we ask what our capacity is now and what the actual upgrade is what the capacity of the upgrade is? So are we doing it for 3,000 people in the town, or are we doing it for 10,000 people in the town?
We already have that information, and we just send that out to you because that's part of the scope of the work.
Thanks.
Yeah. Just
So we
refresh.
send it to the members of the committee just for information.
Was that all, Pam?
Yeah, just to refresh my memory on that, because I just can't recall what capacity levels we were moving to.
Thanks very much, Brenda.
yeah, I'd just like to acknowledge the concerns that Wellington Water Audit opinion with regards to the quality assurance in place. That the auditors are concerned about that.
I think we might be skipping ahead of ourselves.
They're very different issues. So we'll come to that later.
Oh, nice.
So I think.
Okay, so we
just
definitely take on board.
and take on board
Yeah,
the various comments.
absolutely.
Go to assets and services, get Wellington Water, and I know you wouldn't always normally be here, but that'd be important for you to be at assets.
You will be at assets and services, absolutely. Yeah.
Okay, so over to you.
I will let him know that we need to be highlighting that. He already has known that. Okay, so next section is budgeted costs. I did as part of previous meetings was that we wanted to be reporting on a quarterly basis how we were sort of tracking with any costs that we had to incur that weren't necessarily on the annual plan. So I've got those listed there for you. Is there any questions about that?
I just had one, looking around the right-hand centre lessons learned, is that survey that's going out or?
No, so that's so lessons learned is looking at the scope, the project, the procurement, and do we follow best practice? What can we learn to do if we're doing a major project? What can we learn to do better in the future? So There should be a standard operating procedure anytime we do a major capital project. We've not done these things before. In fact, the only first time we did a lessons learned was in the context of the Papawa incident last year, and we did a lessons learned report there, which is a slightly different thing. You should always look back and say, what do we do well, and let's do more of it. What did not go well, and what do we need to make sure we improve in the future? So quality assurance.
Is that the cost of the consultant or is that? And just the recovery committee, it's the back charge from.
No, that's an estimate of, because there's ongoing work with the recovery committee. They're doing surveys, websites, they've got
Communications.
an implementation plan I think that they are developing. Harry, you can probably talk more about this.
Yes, originally we thought that the recovery work would not incur any cost to councils, and practice it actually has. So for instance, we're just doing a survey right now to gather people's views about how the bank councils responded and what we can do better. So it's largely communication than anything else.
So that's an estimate at the moment, because a lot of the cost is being incurred by other councils, and we passed on to us in due course. So that's our best estimate. I think would be fair to say.
That's right.
This is great to see this all in one region. Has anybody got any questions?
Yeah, City Care Parks and Reserve contract increase. Did they have that right with their contract? How does the contract go?
So the contract expired because, and so we've re-signed them for 1 year. But this negotiation happened after, unfortunately, the annual plan was formalised. And so they negotiated another 2.5% increase, and it's for a term of 12 months. So you'll know that it's. No questions.
Sorry, just for completeness, remember this came under council about the issues to do with East Street and encroachment. So this is to actually go ahead and get a policy so that we can apply consistency across. So nearly all of these things here are actually things we haven't spent money on, but they're all things that you've indicated you'd like us to do. So we're just making sure there's a record, because these weren't things that we foresaw in the annual plan, because you never have 100% vision. The aerial mapping is a LiDAR base that we use for all our GIS instruments, and we're part of a consortium that arranges that to happen. So all the other partners are already covered, and so just to say, we need to do our bit and cover innovating streets. You know what that's about? Insurance premiums. That's right. Yeah.
Because unfortunately we negotiate from the 1st of July, but we don't start negotiating our insurance premiums until after probably May, June, and it's after we don't actually find out what the premium is going to be until very close to the end of the financial year. So it's really hard for us to build that into the annual plan, unfortunately. I did build some contingency in there, but it went up more than. The other thing that we didn't take into account was the manganese plant and ensuring that, because it's in the location that it's in, the insurance premiums went up quite a bit for that. Yeah.
So it's a temporary location.
It's a temporary location, so.
Insurance discussion.
Yeah, on the water races survey, whilst that's unbudgeted, that will be coming out of water reserve.
Yeah, absolutely. So in the last column there, I've got how it's going to be funded. So that's by the water rates reserve. Yeah, and then the innovating streets is from the infrastructure reserve, and of course the encroachment of road stopping. We will recover that cost in some once if we sell some sections.
And if you recall, it cost 5,000 for the East Street to purchase land, but it could well be due diligence that's where meter rate goes up and before it well and truly covers cost of the policy.
Yeah, I think that's fair to say that will happen. It just may be a time lag. Yeah.
Okay. No other questions, right?
So it's just a quick one, if I may, on 2.7. cost of paper and cardboard recycling. Are we going to continue sending it to landfill or increase cost, or we can store it? Is there benefit in storing it to the market recoveries?
That is under review with Earthcare, because our Earthcare contract is with the 3 councils, so it's a combined decision effectively. Once again, we're in frequent contact with the amenities manager to give us updates on where that's sitting. Earthcare at the moment has just indicated that this is at the moment what they're expecting their increased cost to be. But there may be some other solutions for it, but at the moment, no one offshore is apparently taking it, and it's actually costing them to get rid of it, whereas previously they were actually being paid for, so people were paying them to take the cardboard and recycling, and now they're having to pay
To dispose of it.
to dispose of it, yes. So they are, part of their contract is that they can't pass some of these costs on to us because it's an unforeseen event.
It'd be interesting to see that this is the kind of idea the government's promoted for product stewardship. So part of the policy response is to make end-to-end responsibility for packaging.
Yeah.
I've got a very gallery for back at home that's empty.
So it puts a whole new perspective on paper roads.
Yes. I'll go and say, if you guys put the road up, nothing.
So before I pass over to Charlie, she's going to run through the financial statements with you. Is there any more questions on the other aspects of the report?
Good to see that quarterly summary.
Yeah, okay, good. Okay, Charlie, you want to quickly run us through the first 2 months of the year?
Yeah, so the first couple of months of the year are always quite difficult to compare to the budget because you put the budget in and then the phasing can be quite different. So we are going to take the opportunity to rephase some of these items that have been highlighted as temporary variances to the budget. So year to date, so for the first 2 months, the surplus is over budget. So that's always a good thing. So we've collected, our surplus is $707,000 over budget for the first 2 months. And the total surplus is $517,000 over budget. The main reason for the difference in that would be those non-cash items. Yeah. Not being quite as big a surplus. So, for example, the subsidy income for the capex on the roads, because the program hasn't ramped up quite as quickly yet, that's behind its budget.
Generally, that always is.
Yeah, I mean, we do try to phase it so that the majority of the cost and the income coming from that is in those busy months, but this year it's just a little bit slower to pick up than normal.
Yeah.
Do you normally smooth it, or we can try to smooth it out for seasonal variants?
Yeah, absolutely, and this is
Yeah.
what we talked
That's
about with
what
land
it's like.
transport. We have tried to do that as best we can and have a look at other years and the phasing from last year, but you never get it quite right, and it can have
Then we get COVID.
Yeah. So we would expect the program to catch up with the budget.
because we're still in very early stages of these 2 months of the year, so we can't really give you a good indication.
Now the one area that is slightly distorted is the miscellaneous income, because we've received 125,000 for that Mayor's Task Force for Jobs.
Oh, yeah.
Now, obviously, the expenses for that, the outgoing grants that we'll pay for from that will then reduce that income, that variance to zero. So, in terms of income, any questions?
I like the little traffic lights on the side.
Yeah, just help, because of course, when you talk about over budget and under budget, when you're
Yeah.
doing income and expenditure, they're the opposite way around,
Yeah.
so.
Sorry, Can you just go over that miscellaneous income again, because it's only budget for 101, if we didn't have that 125.
It would be under, yeah.
How do we get under?
Because it'll be what's in that miscellaneous income and
Yeah, just very small rats of mice income that we get throughout the year. Yeah.
I mean, like, we got 125, would that not mean that we total received 149?
Obviously we to spend, so.
But that's, it doesn't make sense, and maybe someone can explain to me later on.
So
So
we're,
what it's saying to me is that 24K, we're taking 20, out of the 125K that we got, we're spending on 24K of it.
no, this is just the income side of things, so there's no expense in that figure. So without the Mayor's Task Force for Job Income, we would be 24,000 under our budget for income. But
Actually,
once-
today would be 50,000. Does that make sense? No.
Can we,
Yeah. Okay. I'll talk to you after that. That's fine. Rachel, you can have a catch up with that.
So in the operating expenditure, all the red, all the over budgets, have got a qualifiable correction, which is great, so there's no.
Yeah. We've tracked down where the variance is, and some of it is timing.
Sure.
So we will take the opportunity to do I mean, you always have a first cut of your budget phasing and then rephase it a little
And the
bit.
capital expenditure contribution. Lower the budget and come from developments, gets picked up, or is that going to be?
Once again, it's a phasing thing as well. We don't know when we're going to be invoicing the developments. It just depends how they land. So through the year, so I imagine we generally phase that evenly over the year, but it'll be lumpy. Yeah, it'll be lumpy, unfortunately. That's just.
Depends on when the developments are signed off as to when we
Yeah.
get the income, yeah.
It's invoiced, yeah.
But that's a reasonable amount to start the first 2 months.
Jerry, I just had, well, it was an observation of just, oh, this is good. Just looking at Renewal and Fire, where 81,000 is in budget 23. So does this mean having a new event manager has made a significant increase in our income?
I think once again, that's probably just timing.
Like,
But yeah.
talking about
I think it's hard to, with a number of visitors that we've been having and people coming out of the COVID environment and to weddings and all those types of things that were put off and so forth. So I bet you if you looked at the last 2 months of it during COVID, we've gone down. And so swings and roundabouts.
We've been renewing leases on some of our long-term properties as well, so that yeah.
Right, does anybody have any other further questions of Charlie or Trina on these?
I mean, the crucial thing here is we're in a good position, so we're over our revenues and expenditures under. But the trick here is to get the year balanced out. So we know, so the last thing is to assume that trend is going to continue. The classic council books, always the June period, there was a massive spike in expenditure. And so we've got to make sure we've got a very vigilant eye on where our end-of-year position sits relative to this. So I mean, it's as bad to underspend ratepayers' money as to overspend.
Yeah.
So we're going to get that balance right. So how we phase our budgets, how we phase our expenditure is actually the critical task that we've got to really get our heads around from a particular perspective.
Okay, so anything else that you want to make?
No, nothing else. No one else has got anything.
Okay, so thank you very much. Pam, did you want to say anything?
No, nothing from me.
Thank you. Right, so moving on to B3, which is the interim audit report. I'd like to have nominated to receive the interim report. I think Councillor West, any seconder? Any seconder? Oh, Councillor Evans. All in favour?
Aye.
Okay. Yeah, so I'm assuming everybody's had a good read of it. So perhaps, Katrina, if you just go through any of the key areas.
Yeah, look, I think it would be, I'd like to, I'm assuming that we've all read it, and it would be good just to sort of open it up to questions really. Appendix 1 is probably where audit generally sort of highlights the areas that they sort of think need work. And we have got one that's urgent, and that is the survey, the customer survey that we made a decision on earlier in the year that we weren't going to complete. So we knew that audit were going to point that out. It's their job to do that. So
just to be clear, we all remember the reasons why we decided to go. Poor performance of the company, with market research company, bad methodology, we weren't reaching our target markets, and we were concerned COVID would impact on responses. So I personally feel very comfortable we made the decision collectively.
But Katrina, we flagged this to audit when they came.
yes, absolutely.
And they were fine, right?
That's no surprise.
There's difference between they understood
Yeah.
the council had gone through the appropriate decision making.
Yeah.
To make that decision. Doesn't necessarily mean that they're happy with
That's right.
the outcome. So all they're essentially saying is you still have to report.
Yeah.
But they acknowledge that the survey may not be the right measure.
So can we not report that back to the audit and say, look, this is our decision?
Well, yes, and we have done that, but they still put it in their report.
So even though they put it in their report, is there any further action that we need to take?
Can I say something? I think that the reason that they have put it in their report is that what they're saying is if we're not going to use the survey, what are we doing our measurements against? And we need to come up with some theory. We need to come up with what we're putting our measurements against to use for this financial year. Is that right, Katrina?
Yeah, because we can't measure, because a lot of those KPIs were measured on the customer survey. So we can't report on those measures. So, yeah.
I think to be fair, we thought they were put in the report.
Oh,
so
yes.
Yeah, that was definitely discussed.
And then that's a critical thing, is that we've informed you this is an issue and you've made a conscious decision based on that information.
I've got another theory on it. The reason why they put it in there, they had nothing else to bitch about.
If you read this, that's valid.
Exactly.
The main thing.
So, yeah, I mean, I know that you've all read this, so it would be good to get your feedback and sort of any questions that you've got that I can answer for you. There's nothing in here that is unexpected. There's always going to be little things like the resource consent processing days. That's the second recommendation. That was a carryover from last year. So when they were at the audit last year, which was this time last year, they pointed out that we weren't necessarily having a correct process, which we changed immediately. But of course, we still had the July to October where we were doing it incorrectly. So they've had to highlight that again this year because it's not a full year. There's a few months where we may not have been doing it the way that they see as best practice. So
on the 13 recommendations, of the 13 recommendations that the audit what New Zealand asked, how are we tracking?
Most of them we've got covered. So the survey we are doing early next year. That will inform the long-term plan. I think it's going to be. We're all quite, I think, excited about putting together a new customer survey, and I think part of the engagement and what we're doing for the long-term plan will inform how we're going to run that. So I think that will be a really good, we're hopeful that it will be a really good survey that will give us some really good ability to report on how our ratepayers feel about council performance. So I think that runs in hand.
So just to comment on that, of course, we will be rewriting the KPIs for the long-term plan. So what we reported in the past will be completely different to what we're going to report in the future, and be more relevant and more targeted.
Which is what we, I think even going back, Jake, I remember last training, this was discussed.
So I've just covered off the resource consenting days, conflicts of interest register. Now that is around, so Lee has raised this with me, so we all signed our conflicts of interest. So what audit look at is the whole process. They don't necessarily look at 1 year. So what we've, our process has been is that we get the elected members to sign up, sign a conflicts of register for 1 year in the first year. We should be doing it every year. So we do it, although you have done it this year. Yeah. Last year, the outgoing councillors didn't, because the process was that we just did it at the start of the training year. So auditors have just pointed out to us that we actually need to do that. So we will be making that change. Yeah.
So, and it's quite a simple thing, and even though we do express any conflicts of interest at meeting, this is a more extreme.
Most of this that they've got on here is underway, and I will be giving a response to audit about these.
When do they do the final audit?
So that is underway now. We're hoping to be signing off the annual report at the 28th of November's council meeting. We will be signing it off. They spent 3 weeks with us, and they are still tidying up a few things. So we're hoping that sort of in the next week we should be in a position where we're almost finalised everything. Yeah.
Great. I mean, a lot of hard work, so Charlie and Katrina, thanks for bringing them.
How long they were in 3 weeks?
They were in the office physically for 2 full weeks, and then they spent a week working off-site. And then they spent the last week also reviewing. So there's a lot of review processes that go into this.
Great, so any other questions around the audit report? Okay, so we're now moving on to section C, which is publicly excluded business. So moving into public excluded business, the general subject of each matter is to be considered while the public is excluded. The reason for passing this resolution in relation to each matter and the specific grounds of section 48(1) of the Local Government Information and Meetings Act 1987 for the passing of this resolution are as follows. So they refer to the Operation and Risk Register, draft 30/22 financial statements, and Wellington water audit update. So can I have a nominee to pass this resolution?
Yeah.
Councillor second. Alex, all in favour? Say aye. Motion carried. I propose that, thank you, Dan. I propose we have a 5-minute break. Yeah. And then next section.
Yeah, absolutely.
Chair,